Is
A very good afternoon, everybody. It is a huge privilege to host Umesh Agarwal, sir. I know explicitly Umesh sir has asked us not to call him sir, but I'm sorry. But it's just, I guess we are here to learn from you today, sir, in Stalwart series. And we're really excited to learn, the ABCs of NBFC and the exciting topic which sir has decided to enlighten us is NBFC when David meets Goliath and David becomes Goliath, sorry. And if we were to talk about Umesh sir's introduction, Umesh sir is a fund manager with 361 asset. He basically his team works with late stage and pre-IPO companies. He has more than 2 decades of experience. Earlier in his career, he was working as an investment banker and now as a fund manager. So really excited, Umesh sir, to host you and to learn from you in today's session. Over to you, sir.
Thank you, Shailesh. Thank you, Arushi. I don't know if Arushi is here. Pleasure to meet all of you. Wonderful to see nearly 80 plus young minds coming to listen to NBFC on a Saturday afternoon. So that's very encouraging. I will introduce myself and walk you through a little bit about my experience and why I chose this subject. So, hi everyone, I'm Umesh. I have worked for about 26 years in capital market, and first a large part of my career was as an investment banker, wherein I worked with the financial services sector, of which NBFCs was a very large part. I have helped many NBFCs to raise equity capital from private markets, from public markets, doing mergers, acquisitions. And then after completing about 90 transactions on the investment banking side, of which I think 75 to 80% were in the financial services sector, of which lending and of which NBFC was a large part. I moved to 361 Asset to become a fund manager. And I currently oversee a strategy which is called, which is investing into late stage private companies and pre-IPO situations. So we invest in companies which are 1 month, 2, 3, or 4 years ahead of an IPO. So I am now currently in a sector agnostic role. I have about 25 companies in my portfolio with about 8,000 crore of assets deployed. I have got 3 NBFCs in my portfolio out of these 25. Okay, so that's just a quick background. I will use a deck to just give us. I will use a deck to give a structure to the conversation. But let's keep it interactive because I don't know about you. If I'm the only one talking, after some time, myself might fall asleep. So please feel free to stop, ask me a question, or if it's getting too technical, please ask me to simplify. Or if you disagree with something, even better, please highlight it. So I will put up a deck to begin with, and then let's take it from there. Okay. I can't see. Yeah. Shailesh, I cannot see my, quite surprisingly, this is open, but I can't see my.
Sir, maybe try activating the Zoom window. There will be a green button of sharing screen.
Yeah, I've done that. I've done that already, but I can't see my document, which is already open.
Maybe try sharing screen. If it is activated on the
Okay,
screen,
share
it will
screen.
come.
Okay,
Yeah,
sure. Show screen, but
top left
is
corner. Yeah,
can you see it?
not yet, sir. You'll have to press
Yeah.
share. Yeah.
Quite surprising because I do this like day in and day out. So Okay, maybe let me check this out. Yeah. Can you see it now?
Yes, sir. We have the screen in front of us.
Okay, fantastic. So the title of my discussion is NBFC when David becomes Goliath, a very strategic perspective. So what I'm going to do is I'm just going to uh, pick up any one person in random who I can see on the screen. Maybe I can see Gautam, but he's a camera on, right? A87 Gautam. So Gautam, one question to you: if you had to take a loan for a car or a home, okay, or a consumer durable like a TV or a phone, a mobile phone, whom would you go to?
Probably a bank.
Bank. Okay. Anybody else wants to answer? Nikita, A82, Nikita.
Yes, sir. Probably a bank or maybe my parents or
Okay, fantastic. Okay, so anybody, so I presume Gautam, you and Nikita are from a city, like a big city, big town.
yes, sir.
Okay,
Yes,
great.
sir.
Okay, so I think most of the people on this call are like Gautam and Nikita, and I think this looks very similar to to maybe an older version of all of you because all of you are looks like in the early 20s. But I think these pictures are an older version of you all, wherein you go to a bank, which is a nice air-conditioned branch. You get to sit, and there's a bunch of documents to sign. They shake hands. A bank also reaches you through call centers, through mobile banking, through net banking, and and uh, uh, and and other modes. You also see sometimes banks coming to your building during especially during Navratri or Ganesh Chaturthi to sponsor the events, and they want your deposits, right? But what about this class of people? So this is a guy, we can call him Rajesh. He's in Haryana. He never went to school. Now he's in his early 20s. He wants an employment. He first becomes a cleaner on a truck, and now he wants to buy a truck. Okay, he obviously doesn't have any money. Or this farmer who has a piece of land, he wants to mechanize it using a tractor. Or this in a village, a family living in a kacha house and is dreaming of a pakka home. Or this bunch of women who contribute to their households by doing small little jobs like they make idli dosa and sell, or they make flowers and sell. Um, or these women here who work in garment factories and they want to borrow money for their child's education, or this contractor who works in a furniture, no, like who makes furniture for us. So these are the people who also want loans, right? To buy a vehicle, to buy a home, to get finance for their business, and for various other purposes, medical purposes, right? They don't go to banks. They go to entities called non-bank finance companies. Okay, NBFCs. So what is an NBFC? And so NBFC basically gives a loan to borrowers just like banks, but they do not provide various banking services the way a bank gives. So you cannot have a checking account, a savings account. They're not part of the payment system. So your GPay or Paytm, whatever you're using, is linked to a bank account, but not to any account with an NBFC. Even if you have to pay your EMI to an NBFC, you still need some bank account, right? So an NBFC actually borrows from banks and lends to its customers. It borrows from many other sources as well, but large portion uh, of the borrowings that an NBFC does is from banks, and then they lend it to their customers. So that is basically what an NBFC is. Typically, a bank branch is sophisticated. People. It's air conditioned. It's big. It has machines. It has cash counting machines. Whereas an NBFC branch is like a very basic, maybe 150 square feet office with just a tube light and some fans, a few plastic chairs, and in almost all cases not air conditioned. So that's a basic difference. But NBFCs form part of about 21% of the system. Just a second. Just a second. Yeah. But NBFCs form part of about 21% of the system credit in India. And this is up from 15% in FY10. So slowly and steadily, they have increased their share in the system credit in India. So total system credit in India is about 230 trillion rupees, or 230 lakh crores, or for some people who understand dollars better, it would it is about 2.8 trillion dollar, which is 78% of our GDP. So about 21% of that is financed by NBFCs. Okay. The NBFC AUM has grown over the last 10 to 12 years, of course, with some hiccups. Between 14 and 18, the loan book more than doubled, but in mid FY19 onwards, because many of you may or may not recall, in September and October 2018, there were very big events in the Indian economy or Indian capital financial market, which is when an institution called ILNFS went through serious difficulties. They were not able to honor their loan repayments. And another housing finance company called DHFL also was in the same situation. So that led to a period of slow growth for the entire NBFC sector. And then came the mother of all events, which is COVID in March 2020. That also slowed down loan growth, but now it has picked up again. Okay. And there was also a big event. So you can see these two numbers here, 49 and 49, right? So you must be thinking that why did NBFC sector not grow in 24? That's technically correct, but it has grown. The reason why these numbers are same is that a very big housing finance company called HDFC Limited, it merged into HDFC Bank, and therefore FY23 March includes a 5 lakh crore, roughly the size of HDFC Limited, but this 49 in 24 does not include the size of HDFC because it's now part of the bank. Okay. So NBFCs are very specialized. They're specialized lenders, and they have pioneered many segments. So the largest segments are home loans. So as we said, the 21% of the credit of that, nearly a third is in home loans. A quarter is in infrastructure loans. Vehicle or equipment loans is another 12%. Loan against property or small enterprise. So loans to small and medium-sized enterprises is 10%. Other consumer loans like loan against gold, microfinance, etc., is another 9%. And there are other smaller product segments as well, like loan against real estate, which at one time used to be much bigger, but it's got reduced quite a bit, especially after DHFL went down. Okay, so that's the split of all these loans that NBFCs do. Why they call specialized lenders? Because most of the NBFCs they will choose one or two of these products and focus on them. So they'll become specialist vehicle financiers. Like HDFC in its entire life for about maybe 50 years was only doing housing finance. Okay. So that's why we are calling them as specialist financiers, unlike banks, which sell, which usually have a very multi-product portfolio. So they want you to do payments with them. They want you to take a car loan from them. They want you to take a home loan from them. They also want to sell you mutual funds. They want to sell you insurance. They want to do everything, right? Whereas NBFCs tend to be very, very specialized. So NBFCs dominate several of the product segments that they are in. And in micro credit loans, which is very small ticket loans, and I will come to that a little later. So while we saw overall share of 21% in credit, but in certain product segments, the share of NBFCs is much higher. So for example, in microcredit loans, it's nearly like 48%. In auto loans, it's 47%. So meaning the balance is, of course, with banks. Okay. And if we cut it down further into by, like if you break this auto loans into car loans, okay, versus say commercial vehicle loans. So in car loans, the share of banks will be much higher than 53%, but in commercial vehicle loans, the share of NBFCs will be much higher than 47%. If you break up commercial vehicles further into new commercial vehicles and old commercial vehicles or used commercial vehicles, then in new commercial vehicles, the banks will have a greater share, but in old commercial or used commercial vehicles, the NBFCs will have a greater share. And and similarly, in the case of cars, while in new cars, the banks will have a greater share, but in used cars, it will be NBFCs who will have a greater share. Or in ticket sizes, when in home loans, so NBFCs will typically be operating in loan ticket sizes of as low as say a few lakh rupees, okay, up to maybe 20-30 lakh rupees. But banks typically will give loans of 50 lakhs and above, or maybe 1 crore and above, especially in the bigger cities like Bombay, Delhi, Bangalore, etc. Okay. So I'll pause here. Any questions so far? Any comments? Anybody wants to share anything or any experience of having dealt with an NBFC?
No questions sir, so far. Just one thing where I was a little bit curious. On the education loan side, what is usually the market share which is grabbed by these NBFCs?
Yeah. So education loans we can split into two: domestic loans and overseas education loans. Okay. So there are two large NBFCs. One is Credila, which was owned by HDFC for all these years, and only a few months back, 6 months back, it got sold to a private equity fund. That's the largest education loan company. I think it must be having, if I'm not mistaken, a loan book of maybe something like somewhere between 20 and 30,000 crores. Okay, and the second largest company is a company called Avance, which must be around 10 to 12,000 crore of loan book. So in overseas space, it is the NBFCs. Whereas in the domestic space, it has been so far more a business being done by banks, but the approach of banks has been very, very different. Shailesh, they have seen it as a plus product, so they have largely focused it on an existing customer who's also now wants an education loan, so they have credit history with the bank, and they've also seen it as a product where they take mortgage of the parents' property. Okay, so it is more like, okay, give me your house as a mortgage, as a security, and take education loan for your child. But the way Credila or Avance has done their business is very, very different. They don't take security of a property for most of their loans, and what they do is real work on the ground. They will do an understanding of all the various educational institutions overseas in US, UK, Australia, etc. Map them, understand their cost structures, understand the salaries that people can draw, understand the profile of children, and they actually underwrite the potential of the child uh, to repay the loan, and they give the loans on that basis. So there's a huge difference between the way in which an NBFC gives an education loan versus a bank.
Got it, sir. Thank you, sir. There are two questions which I have from participants. One is from Ali. He has a question on share of NBFC in overall credit industry, as you mentioned, in terms of growth rate, he wanted to have a bit more insights in terms of share of NBFC in overall credit market.
Yeah, I think that was the first slide. It's 21%.
Got it.
So in
And
March 23, it was 24. In March 24, it is 21 because HDFC has moved out to the banking system after merger into HDFC Bank.
got it. Fair enough. And there is another question from Rahil. He basically wants to ask, recently, because of low interest rates in Japan, a lot of NBFCs have been borrowing from Japan, and then eventually, now that the sudden interest rate increase which Bank of Japan is getting into, what kind of pressure do you anticipate it creating on the overall NBFC ALM side?
Yeah. So I think a very small proportion of NBFCs are really borrowing overseas. There are a lot of restrictions on NBFCs. So it's mostly the infrastructure finance companies which are borrowing from Japan, because there's a lot of relationship between India and Japan, especially on financing infrastructure. So with the rates going up, certainly there will be some pressure on the NIMs of these companies. But the wider NBFCs are really not borrowing from overseas. Like a very small part of balance sheets of NBFCs are from overseas borrowing. ECBs is not a very widely used product.
All right, sir. I think there are a few questions, but I anticipate them to be covered in the upcoming slides. So
Yeah.
we'll probably, yes, sir. Thank
Okay.
you.
Okay, so now let's go to the landscape of NBFCs. So various types of NBFCs. You have perhaps six to seven types of companies. One is an asset finance company, a company that focuses on giving loans like against automobiles, tractors, equipment like machinery, etc. A loan company is simply which is giving a loan, say for to a micro, small, medium enterprise. An investment company is what, say, any of us can incorporate, and we can do our investing either in our own name or through an investment company. Housing finance company does only financing of purchase or even construction of houses. Infrastructure finance companies, infrastructure loans. Core investment companies, interesting. So typically these large conglomerate groups like, say, Birla Group or Adani, or some of these very big groups who have multiple companies. So they typically have a holding company which from there then invests in other companies. So for example, the Bajaj Group, there is a company called Bajaj Holding and Investment Company is a listed company. The promoters own that company, and that is the company that has investments in two arms. One is Bajaj Auto, and then there is Bajaj FinServ. Then Bajaj FinServ has a subsidiary, which is Bajaj Finance, and now Bajaj Finance has another subsidiary, which is Bajaj Housing Finance. So core investment company is a company which is used by large groups for investing in their own group companies. Microfinance institutions are companies which lend to customers whose annual income is less than 3 lakh rupees. Okay, so there are special privileges, incentives for such companies to enable financial inclusion, and hence there is a separate class of NBFCs for them. Factors to do the business of factoring, but there are only a couple of NBFC factors in the country, because even a lot of the banks have got competing products. Mortgage guarantee companies are which guarantee mortgages, but again, this is not a very big business in India. So this is by the type of work that NBFC does. You can also cut NBFCs on the basis of whether they take public deposits or they don't take public deposits. So I will spend a minute here, some interesting trivia for you all. So in the late 90s, okay, or in the period of the 90s, most of NBFCs were also allowed to take public deposits. Just the way banks today take deposits. But then there was a very big scam in the late 90s, in I think 1998, where this NBFC called CRB, okay, it went bust and and a lot of people lost money. So after that, RBI, the Reserve Bank of India, which is the master regulator for NBFCs, uh, they stopped the NBFCs from taking public deposits, barring a few. So even today, even after some 25 years of that incident, not more than half a dozen of NBFCs are allowed to take public deposits, and no new licenses have been given, at least in the last 20 years, which allows NBFC. Only the big ones like Mahindra Finance, Bajaj Finance, Shriram Finance, who had licenses from that time, have continued their licenses, but no new licenses have been given. Okay, so I wanted to know, did anybody know about this? Did anybody know about CRB scam? Have you? Is there anybody who had heard about this scam? No. Okay. So there are about 37 companies. There are about 37 NBFCs which are listed in the stock market with a total market cap of 20 lakh crore, 20 trillion rupees. And this has a very healthy mix of small and mid sized companies and large companies. So about 21 out of these 37 are having market cap of less than 25,000 crore or less than $3 billion. And the remaining, which is around 16 companies, are more than 25,000 crores. And this is quite interesting, as I had shown in the earlier slides, that they are specialized. There are specialized lenders. So MFIs, MSME companies, or personal loan companies, gold loan companies, or housing finance companies. So there are specialized companies, and in each of the segments, you will find quite a few of these segments have only, like, couple of companies listed. Like there are only 2 gold loan companies listed. Okay, and there are only 9 housing finance companies listed. So in each segment, you will find only a couple, or at best a few companies. And there has been a trend of companies becoming more diversified. So you have about 7 large diversified companies which are listed. Okay, and a few more are likely to list in the near term. Last 10 days saw IPOs of 2 companies, which is of which name is written here, which is Bajaj Housing Finance and Northern Arc. But this data is as of 13 September. So I have still included them. So in the next maybe couple of years, another 3 lakh crore of market cap will get added. So this market cap could go from 20 trillion to maybe 23 trillion in the next couple of years. Okay. So what is a moat for an NBFC, or what is a sustainable advantage? Okay, I think let's spend some time on understanding this. This is the question that you have to ask when you're analyzing when you're analyzing any NBFC, whether as a buy side analyst or a sell side analyst or a banker or an investor. So the first and foremost principle for an NBFC is that it should not compete with banks. Okay, and why is that? Because for an NBFC, access to borrowings and the cost of borrowings is extremely important. Okay, and largely NBFCs borrow from banks. Nearly 40 to 50% of an NBFC's balance sheet is from banks. So which means that they have to lend at rates higher than banks to make money, to meet their cost of borrowing, to meet their operational cost and all other costs. So which means they have to lend at rates higher than banks. How will they do that if they compete with the bank? So they have to find their own customer segment. They have to find their own geography where a bank cannot reach, and 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 create a business for themselves. The second aspect is of collections, and we'll spend some time on this in the next slide, and of borrowings. Okay, so essentially there's a tripod or troika, as you may call it, that you should understand every NBFC's moat from the point of view of its customers, geography, borrowings, and collections. Okay. So typically, any NBFC should look to tap an underserved customer, okay, underserved by banks, or an underpenetrated geography where a bank cannot reach. Okay. And what does an underserved customer mean? He also would come with a concept called thin file. Now, what is a thin file? I think most of us here, as I asked in the beginning, if you had to take a loan, who would you go to? Answer was bank, because many of us will have a Form 16 because we are salaried, or if we have businesses, we'll have some GST return. So we'll have essentially a thick file, right? And this the basis of our salary slips, Form 16, income tax return, GST return. A bank will be able to give you a loan, if not in a few minutes, maybe in a few hours, right? But these customers do not have do not have IT returns, they don't have Form 16s, they don't have GST returns. As you know, in a country of 140 crore, I'm sure this data set you would know only about 7 to 8 crore people file income tax return in a country of 140 crores, right? So look for customers who don't have these documentation. Look for geographies where banks cannot reach. Look for small ticket size loans. So for banks doing 3 lakh, 5 lakh, 10 lakh loans, it doesn't move the needle. They generally look for bigger ticket loans, and look for secured loans, but which are difficult to enforce a security. So, for example, a car loan or a vehicle loan, commercial vehicle loan, is actually a secured loan because you are taking that asset as a security. But in reality, it is very hard to enforce that security because the person can be absconding, or you'll not be able to find your vehicle. He can just change that he can just change the number plate, and you will not be able to identify the vehicle unless you look for the chassis number. So these are very expensive. So these are very, you can say, theoretically they are secured, but there has to be many other ways that an NBFC needs to have in terms of its presence on the ground, through branches, through feet on street, through his network, to be in touch with these customers. Okay. And also, when you're giving loans of 5 lakh rupees or 8 lakh rupees, typically the value of that house will be 15 or 20 lakhs. And India is still a very socialist country, where if you try to send a notice to a poor person, and you try to repossess his house, which means the family of women, children, etc., will become beggar or homeless. I think it will cause a lot of it'll cause a lot of social problem. So typically these are secured in theory, but in practice it is very hard to enforce these securities. Okay. So you should evaluate how the NBFC is choosing its customers, its geography, and how it is dealing with these kind of nuances. Okay. And I would say that lending is actually not a business of giving loans. It's very easy to set up a small desk outside the building, outside the office, on the footpath, and you can build a 1,000 crore loan book in just a couple of days, because we are a poor country. Everybody wants a loan, and you'll be able to give loans. But the real test is in collections. Okay. So it's actually a business of collections. And the type of customers that are typically NBFC works with are hand to mouth. These are people who are earning maybe 25,000 rupees a month, or 50,000 rupees a month. And it's very essential to collect that loan on that due date. Just imagine you have given a loan to to a person who is driving a commercial vehicle. Okay. And he goes from, say, Maharashtra to Orissa and back. He's not going to be there. He's not going to plan his trips, that I have to be on the 30th when my EMI is due. I have to be there to give the money in cash Let's say most of these people don't have bank accounts. They get their payments for their trips in cash. So how do you collect in advance? So what kind of presence that NBFC builds, that they know that the loan officer or the collection officer knows that this guy, he does these kind of trips on the 30th, he's not going to be there in his town, so I have to catch him on 28th before he goes for a trip. So those are the real collection methods on the ground that an NBFC has to put in place to ensure that they collect the EMI on due date or maybe even prior to that. Because a missed EMI it gets very hard to recover later. These people, they don't necessarily have great saving habits. Their expenses usually are very high, or if there is a medical situation in the family, they will just use up the money to pay for that, and it'll be very hard to recover a missed EMI later. And that is what we saw even during COVID, where for 3, 4, 5 months, a lot of the poor people lost their livelihood, and many of those installments could not be repaid for the next 2 to 3 years. Okay, so it's very important that the metrics, okay, and most companies, they give out this metric of 1 DPD, which is number of EMIs which are not paid on the day they are due. So days past due, DPD is days past due, 1 DPD. Okay, they share this data that how many EMIs are not paid on the day when they are due. So this is tracking this is tracking the early delinquencies and taking swift action through calling them on their mobile phones, or if they are not repaying after 2 days, to send a collection officer to look for them, etc. So this is the kind of data that most listed NBFCs also publish in their investor presentations, and that you can track. They should look for an understanding of their collection of the collection field force across geographies where the customers are. One of the reasons why fintechs, okay, why fintechs haven't really succeeded in growing their AUMs very large, or their credit costs have been far higher than some of these traditional NBFCs, is because these fintechs have largely relied on digital sources or digital routes like apps and web and calling to source the loans, but they never invested early on in actual field collection. So if they gave a loan through an app or on the internet, but there was a default, they had never met the customer in person, they didn't have branches in the regions where the customers were, and all they had was ability to only call them or send SMSs to them, etc. So investing in a field force for any NBFC on the ground to collect is extremely important, and it is very hard to build your own staff in all the regions. You could be operating in a few thousand pin codes, so it'll be hard to have your own person in every single pin code. So a lot of NBFCs do is that they do a combination of their own field force and third-party agencies. Okay, I think I already covered the point of security, like a two-wheeler or a commercial vehicle or a very small homes where they're very difficult to possess. So I'll just pause here. If there are any questions on this aspect of the business model and the moat.
Yes, sir. Thank you for, summarizing it in a very, very simple manner, that a successful NBFC is only backed by how good the collection team is and
Yeah.
how the loan disbursement policy works. Obviously they are catering to a crowd which is not so credit worthy after all, with lack of documentation, as you mentioned, Form 16 and few other credit worthiness. But then the collection is a key, and action, identifying during the delinquency period itself, uh, nips the problem in the bud. Now, sir, something which recently, not recently, but maybe a year or 2 years back, got a lot of press, bad press, was the BNPL startups, buy now pay later kind of. They were trying to fuel a credit bubble, which would have actually turned out pretty bad. I'm not really sure how the ground level activity on that front right now is, because with no documentation, no ground level sales team to recover, perhaps, or maybe with little or no documentation, these buy now pay later, how have they changed the industry? Has it been just a temporary blip or something which you foresee to become a new norm with new tech uh, processes being introduced, and how do you see that impacting the overall industry?
Okay, very good question. And I have a slightly longish answer for that, but it'll be useful for you to get this perspective. So, personal loans, as we call it, or short-term personal loans, um, I can take you back in history a little bit. Okay, in 2008, I'm sure many of you would have read there was this great financial crisis, as we call it, GFC, in 2008, which was the first time when this personal loan crisis really happened. Okay. Uh, the unsecured personal loan as a product was a product which started in India, gained traction only in maybe after 2002, 2003. Okay, there was no real concept of personal loan before that. There were maybe a few lakh people who had credit cards at that point in time. But in after 2000s, this concept of personal loan came in, and ICICI Bank, GE Consumer Finance, Citibank, they were the pioneers. In 2008 was the first time when this personal loan bubble burst, and there was huge number of losses. And I have got two case studies here down there where I have covered this point, where companies nearly went bankrupt, including ICICI Bank went through a period of deep stress. Okay, that got repeated uh, in COVID. Okay, where the personal loans had as a product had got built up largely by fintechs. Okay, with you had all these fintechs who were using digital ways to source these loans, but never invested in the collection infrastructure, and they had to suffer they had to suffer a lot of losses. Since then, Shailesh, what has changed is in the entire digital world, not just in lending, but in consumer tech as well, online to offline or omni-channel, the concept of omni-channel, most tech businesses today are omni-channel, right? Like Lenskart, which was meant to be only an online business, now has now significant retail presence, like stores. First Cry also has stores, and even Nykaa has stores, right? So most of these fintechs, after this experience of 2020 COVID, they have invested in collection infrastructure, either on their own or, as I have written in the second last bullet on this slide, through combination of third-party agencies. So there are independent third-party collection companies that work with these fintechs. Okay, they have now invested. So while sourcing remains digital online, but all of them have realized the importance of physical collection infrastructure. And there are, I mean, I can give you some, trivia what many of these collection officers do. So there are a lot of moral code of conduct which banks and NBFCs have to sign with RBI. Okay, that you cannot send a collection officer after 6 p.m. Okay, like in the night to a defaulting customer's house. If a lady is alone in the house, then you need to have a lady, etc. So there's a lot of thing. What these people do is they go with the band के साथ में. So they will go with a band wala, and they'll make noise outside the house. So a lot of people will come to know that there is something happening here, and they will try to put some kind of social pressure on the people that you are a loan defaulter. So all these kind of things are happening to help these companies improve their collection tools. So the big change is from pure online to online plus offline, where a lot of the collection is offline. Does that answer your question, Shailesh?
Yes, sir, definitely. Thank you so much for such a detailed answer, sir.
Okay.
All right, sir. So, one generic question which comes to my head after listening to what we discussed. So the only way NBFC actually can make a decent amount of money is they have a higher cost of capital and they can lend to less credible borrowers, or probably people who don't have that kind of a credit score, or who can't really get much of a customized flexibility and few other aspects from other banking firms. But then from a investor perspective, for us, it is, after all, the principal is also at risk, right? Because let's say the bank has a lot of borrowed capital, the NBFC, I mean, has a lot of borrowed capital, and which is eventually being lent outside. So from an investor perspective, how do you go about taking a look at NBFC as a business? How do you think about analyzing the quality of loan book which they may have?
Yeah.
And how do you go about taking a look whether, because after all, it's a commodity service which they are offering, pricing here and there, but the margins would remain more or less same. But then eventually the discipline towards lending and the credibility of the loan book eventually should define sustainability in long-term future. So from an investor perspective, how do you go about taking a look at that, sir?
Okay, so I'll come to that. I have some case studies, and I've covered credit costs, and so just give me a few minutes. I'll go to the next slide, Shailesh.
Yes, sir.
So as I said, there are three things. There is customer geography, there is collections, and the third thing is borrowings, right? So I covered customer and geography, I covered collections, and now comes borrowings. Okay. So typically NBFCs borrow from banks and capital markets. So typical NBFCs, including housing finance company, they rely on wholesale funding. As I told you, most NBFCs, HFCs are not allowed to take public deposits other than really less than half a dozen. So about 36% of borrowings of an NBFC comes from the capital market, which is through debentures. Equal proportion comes from other banks, and there are other tools like commercial papers, borrowings from financial institutions. So here is where some of those Japanese the ECBs is there, which is borrowings from financial institutions like IFC, International Finance Corporation, or there are these multilateral institutions who lend to certain specific types of NBFCs. And as I said, public deposits is less than 5% because only a few companies like Bajaj and Mahindra and Shriram are taking deposits. Okay, so what really drives the borrowing, and it is very important for an NBFC to do two things: have a diversified source of borrowing, so not rely only on banks, not rely overly on debentures, but have a good mix of them within banks, not rely on just a few banks, but have at least, so there are about 35 banks in India across public sector, private sector, mota. So at least 15-20 banks have to be lending to you. And there are maybe about 40 mutual funds in India. You should have at least half a dozen or at least 8 to 10 mutual fund relationships who will be investing in your paper. So key determinants of access and cost of funds. Okay. So number one is parentage. Okay. Number one is parentage. And here is a very strange, I would say, I would also use the word unfortunate part of the NBFC world, where every time an NBFC goes to a bank to borrow, the first question that a bank asks him in Hindi is, उसको पूछते हैं तेरा बाप कौन है? Okay. That's the first question that a bank asks an NBFC कि भाई तेरा बाप कौन है? So what it means is that the parentage, so a Bajaj Housing Finance or a Bajaj Finance, it has a rich daddy. So it has a Bajaj family who will stand behind the NBFCs. And this started this is a trigger of what happened in 2008 when the great financial crisis happened and NBFCs went through very difficult time. Okay. And only those NBFCs which had strong parentage, like Aditya Birla Group had an NBFC, Tata Group had an NBFC, Bajaj or Murugappa, those came out of those issues very easily. And also, to be very frank, banks are known for what even the regulator says, lazy lending. Okay. Uh, uh, so as they say, in very practical words, okay, bank employee typically he does his business by sitting in a nice air conditioned office where the temperature of the AC is 22 23 degrees, whereas an NBFC person actually works out in the field in the heat, in come rain, come flood, come heat, right? So banks typically say, "Acha, this NBFC is part of this very big group. We know they will not default, so they will lend." Okay. Or there's a marquee P investor. So there are some very large private equity in funds in India who have promoted a lot of NBFCs. You have Warburg Pincus, you have True North, you have Blackstone, etc., who have invested maybe anywhere between 5 billion to 10 billion in India now, and they are like the new promoters uh, in India. So banks also respect them, that a Warburg will not let an NBFC which is promoted by them to default. Third is vintage. How old is the NBFC? What is its history of loans? Because typically loans are 3 years, 4 years. So have they gone through 2 or 3 cycles, right? And what has been the credit cost history? Then another tool, there are another 3 very important tools, with the securitization, priority sector lending, and support from NHB. So what is securitization? Securitization, as I said, banks are they, you can accuse them of lazy lending. What they do is they find it very hard to go and lend to commercial vehicle customers for some of the reasons that I described to you. They are small ticket, they are thin file, they are all over the country. You have to literally run behind a truck wala to catch him and get your EMI. Okay, so just imagine a bank employee dressed in a suit and a tie running behind a truck guy. So what they do is that they work with NBFCs, and they tell them that you get these loans and you securitize through. So there's a concept of, of, of a pool of receivables, and you put them into a pool, into a trust, and I will put money in that trust. Okay, so through pass through certificates, PTC, or I will buy that full pool, and you even give me some security. So if it's a 100 rupee pool, you put 105 rupees in it. Okay, so put or let me put it this way: you put receivables of 105 rupees, and I will give you 100 rupees. So there's a 5 rupee security also that they take. Okay. So a lot of these NBFCs, they also work with banks through the securitization route. And many banks also start relationship with a new NBFC through securitization. After seeing 1 or 2 loan cycles, they extend the relationship by giving them a term loan. Okay. Then there's a concept of priority sector lending. I think this is a very interesting concept. As I said, India is a socialist country, and we all have, for the last 75 years, there has been all these slogans of Jai Jawan, Jai Kisan, Garibi Hatao, and equality and all these things. So there's a concept of directed lending, where the regulator asks banks that you need to invest a certain part of your loans into certain types, into geographies, like tier 2, 3, 4 locations, or to the agri sector, to micro, small, and medium enterprises. So all the 35 banks have to have a certain part of their loans which qualify for this, what we call as priority sector lending, and it's very hard for these banks to meet these targets. So what they do is that these NBFCs, most of the NBFCs, their loans qualify for PSL. And what the regulator therefore has done is that if a bank lends to an NBFCs whose loans qualify for PSL, then the loan to that NBFCs qualifies as towards the target of the bank, or this securitization paper, it will qualify towards that target. So PSL is a very big tool, that NBFCs use to get access to bank borrowings at very competitive rates. Okay. Um, and the rules that the penalties that a bank has to face for not meeting PSL target, they are very, very stringent. Okay, so it is a huge loss to the banks if they don't meet their PSL targets, and hence they make sure that either they source these loans themselves or they work with NBFCs and who help them meet these targets. Third is NHB. NHB is National Housing Bank, which is an institution which uh, which gives loans to housing finance companies for onward lending of certain small ticket size loans. You may all have heard of this Pradhan Mantri Awas Yojana, right? PMAY. For the last more than 10 years, this yojana has been going on where the government gives um, so broadly, I mean, I may not be 100% right in, but I'm just giving you an example. What this scheme always did was that if you took a loan of say 10 lakh rupees, okay, nearly 2.5 lakh rupees was given by the government under this scheme, okay. Um, so um, uh, so NHB finances these smaller housing finance companies who are giving housing finance loans to these poor people. Okay, and these loans come at very, very low rates, and nearly anywhere between 15 to 25% of the borrowings of an HFC, a housing finance company, now comes from NHB. Okay, so it's a very big source of financing. Um, so Shailesh, you made a comment that are these customers credit worthy? I think that's the word you used. That maybe the customers of NBFCs are not credit worthy or they're not credible. So that's actually my next question. Are credit poor customers truly poor credit? And here I want to ask, some of the audience here, what is their initial reaction? That are the credit costs of these poor customers, okay? What is your gut feel? Are they higher? Are they lower? Uh, like what is the perception you have? Yeah, Harman, go.
Harman, I
I
want
think
to.
so. Cost will be higher because the risk involved is too much higher.
Okay, okay. Rahel?
Yes, sir. Even I feel that since we know that the customer is not very well off, so the risk involved is really high. So the bank will obviously, or the NBFC will obviously charge a higher credit for them because the probability of default is also high.
Okay, okay. Good. Maitri, Parik?
Sir, as per the ground report, there may be a lower chance that credit poor customers are truly poor because they have the ability to pay compared to many so-called higher credit customers.
Yeah, yeah. Good, perfect. So, while I will get into data, but I can tell you that in my 25 years experience in financial market, okay, uh, there have been many bank failures, okay, in the period from 2000 to 2010. Quite a few banks have gone belly up. Recently, you saw Yes Bank going through a lot of trouble, okay, uh, and all the source of trouble and the entire period from 2012 to 2020 before COVID, this whole public sector bank crisis where they had lent uh, to iron and steel companies, to telecom companies, right? Then um, um, so they went through so much stress. All these were corporate loans. All this were wholesale loans. Okay. I don't know of any bank or any NBFC that has gone belly up by lending to the poor. Okay. There were only two NBFCs which have caused stress to the system, which is ILNFS, okay, in 2018. But ILNFS, it never lent to the poor. It was lending to big infrastructure projects. Okay, DHFL was giving loans for houses. It went belly up not because its customers did not pay the loans back. It went belly up because its promoter, did certain things where he misappropriated, or at least those were the allegations against him, that he misappropriated the funds from the balance sheet, and he was siphoning off money. So yes, the credit cost of a poor customer would be higher, but then he also borrows at a higher rate. Typically, I think most of the people, all of us on this call, if any of us had to take a home loan, what is your guess? What is the interest rate that any of us on this call will pay? Any guess?
8.5 to 9.
Yeah, I think that's also on the higher side. Okay. During IPL last year, May 23, I think the most prominent ad was of Kotak Mahindra Bank, giving, it was irritating. After every over, they were giving an ad, say that is unbelievable, a home loan at some 6.9%. How many of you remember that ad? Yeah, it was sub 7%. But these poor people, they borrow a home loan at more than 13%. Okay, so it's that starkly different, and therefore the housing finance company has enough buffer for the loans to go bad. Okay, but let's also look at the actual experience. Okay, so in the year 2000, as I said, after this CRB scam that happened, that I mentioned about, the first time RBI came up with CIBIL, which is a Credit Information Bureau of India. It was created, and it launched its first ever consumer credit bureau in 2004. Okay, and then 2008 is when great financial crisis happened. More credit bureaus came to India, Equifax, Experian, and CRIF, they got the license. But until 2015, okay, these were operating in silos. The data was it was fragmented. They were all holding it with themselves, and it was not being shared by all the lenders. Credit underwriting was therefore equal to asset underwriting, meaning, I can give you an example. So, Tata Motors, a commercial vehicle, has this product called ACE. Uh, if you're in any city, any road, there is a small little, Tata ACE, which is a small four-wheeler. It goes very slow, but it is the most used vehicle for intracity transport. Okay, so that product was financed irrespective of the borrower. Okay, the financier would look at, हाँ, Tata Ace है, बहुत अच्छा product है. If he is flying in this city, he will get this kind of business. These are the economics of the product. It costs so much to run it, maintenance cost, and he will. So these NBFCs had a proper P&L for Tata Ace, and anybody with a driver's license, if he has worked for 3-4 years in the transport industry, he will get a loan. Okay, so it became an underwriting of the asset, not really of the customer. So it led to development of product lenders or product experts. Then in 2015, RBI mandated every bank and every NBFCs that you have to compulsorily share all your information of all the customers, all the loans, of course, masked without names, with all the bureaus. Okay, and then it in a standardized format. This led to creation of a very detailed data repository, and it led to creation of underwriting models, which are now based not only on the asset but on customer behavior and also on overall market data. Okay, so this led to completely transforming the way NBFCs now lend. I think Shailesh, you asked this question earlier. So earlier, the loans were given just based on the CIBIL score. If you have a loan score above 750, you are good credit, loan given, no question asked. Okay. So what is your track record? At the most, they would look at, okay, what is your track record? What is your your indebtedness level today? Okay, आज आपका कितना loan है? What is your income today and what is your loan today? Do you have ability to pay the EMI? Fixed obligation to income ratio, FOIR is a very commonly used term, that fixed obligation to income ratio 40% है तो उसको दे दो loan. Okay. But then came predictive bureau insights there where they started to tap data, especially for new to credit customers. Okay, especially for customers who did not have bank statements to show that what is my income. Okay, person working in a sari shop getting his salary of 10,000 rupees in cash and he gets another 10,000 rupees monthly incentive for meeting his targets. How do you evaluate his how do you evaluate his credit history? So all these NBFCs, they built models, data. Okay, you are in a town called Solapur, you're working in a garment store, आपका income इतना होगा, you're working in this market. So they have that granular level of data and it is pooled from various NBFCs. Okay, this market in this city performs like this. And proxy data. So if you're new to credit, if there's a loan application from Rahil, okay, he's a new customer, but there was a Rahil 3 years back who took a loan. He was of the same profile and this is how he behaved. So they even have proxy profiles. So multi-dimensional the underwriting, multi-dimensional underwriting models are now used by NBFCs. And let's look at 4 examples. So Awas Financier, which is a housing finance company, gives an average ticket size of home loan is 10 lakh rupees. 40% is salaried customer, 60% is self-employed. Even this 40% salaried is not people like some of the people on this call who have a Form 16 and a pay slip. It will be like the sari shop customer I told you who gets 10,000 rupees in cash and another 10,000 rupee again in cash, which is unpredictable. So it is that kind of salaried customer. Or SBFC, which gives a loan to other micro, small, medium enterprises. Credit Access, which is a microfinance company where the average size of the loan is 54,000 rupees. Okay. So let's look at some experience in FY24. So Awas, you all will be familiar with the concept of GNPA. If not, I will just spend half a minute on it. Basically, RBI requires you to make provision for loans, which is okay. So there are rules that after if your EMI has not been paid for 90 days, so it is 3 EMIs are not paid. Okay, so they become they go into the GNPA. Okay, and you have to start to make a provision for it. So for Awas, 0.9% of his loans are customers who have not paid 3 EMIs. Okay, but credit cost in a year is only 0.2%, because that 0.7% guys are only they have maybe having temporary cash flow mismatch. Okay, and the eventual loss is only 0.2%. That's a huge difference. Okay. Same for SBFC, where the GNPA is 2.4, but actual loss is roughly only 1/3 of that, or less than 1/3 of that, which is 0.7%. And same is the case for a company like Mahindra Finance, where the GNPA is very high, but actual credit costs are very low. Okay, so here I want to now go back to this question: Are credit poor customers truly poor credit? I don't think so, because if you look at the risk-adjusted return or risk-adjusted interest rate, okay, except during COVID, when microfinance customer, so that is a very, very different class of customer who is taking 30, 40, 50,000 rupees loan, truly hand to mouth, and he's not able to come out of the debt cycle. That is the only class that has given very big losses to the lending world. But whether it is commercial vehicle companies, whether it is business loan companies or housing finance companies, they have not really led to massive defaults where where a company has got shaken up. Okay, so the reason why these loan rates are very high, as I said, like 7 to 8% from a Kotak or an Axis or an ICICI bank to us versus a 12, 13, 14% for these is the ticket size, because these loans are tend to be smaller ticket size. I can get a home loan in less than 24 hours today. If I just type now on Google, I want a home loan, somehow, or on my mobile phone, I will have it. I will get so many calls in next 24 hours where everybody, all these banks will just like really haunt me, and I can get an approval in one day on just basis my form 16. But here you have to go to this guy, you have to understand his occupation, you have to track his cash flows, you have to do a lot of work, and that costs. And then the loan size is only 10 lakhs. Like many of us will take a home loan of 1 crore to a few crores, right? But these customers will be taking 8 to 10 lakh rupee loans. So that's why the interest rate tends to be very high. Okay. The other big change that happened is in liability. Okay, so as I said, the three things which are the moat of an NBFC, the third was borrowings, and a massive change happened in 2018. And I'll go back to September, October 2018 when ILNFS and DHFL and Yes Bank, all these three institutions shook the entire financial system. After that, there was a massive impact on NBFC's ability to borrow, both from banks and from capital market. And then came 2020, COVID. Again, there was a huge impact on the loans. Okay, which led to severe issues for NBFCs to be able to borrow from the capital market and the banks. And here again, I will go back to that statement that when an NBFC goes to a bank to borrow, the first question they ask is is iski tere baap ka naam kya hai? Okay, so that's what exactly happened in FY19. So prior to that, from 14 to 19, the total debt to NBFCs moved from 11 trillion rupees to 21 trillion. But then from 19 to 22, it just stagnated between 21 trillion or between 23 trillion to 26 trillion. Okay. And then it is only now, last 2 years, that this has picked up. This entire period is the post ILNFS, Yes Bank, DHFL, and COVID period. So in this period, what happened was that in August 18, just prior to those events, the total exposure of mutual fund, for example, which is the debenture part of the balance sheet, was 4.4 lakh crores or 4.4 trillion rupees. That actually has come down. It came down to 1.9 trillion rupees in September 22. Okay, and now it has moved up. So there is now a pickup. And here you should not look at this 0.8 and 0.7 because this 0.7 does not include HDFC and 0.8 includes HDFC. Okay, but if you look at the dark blue, the 1.1 trillion, which used to be 2.5 in August 18, is now inching up, is now really moved up to 1.9. So things have changed after a long gap of 5 to 6 years. And in this period, what happened is again that, what's the name of your papa? Do you have a big daddy? Okay. So the AAA rated private NBFCs is the one in between. And you had all these key PSU NBFCs where government was the parent. So Rural Electrification Corporation, REC, PFC, PNB Housing Finance, many of these NBFCs which were promoted by government, their share in credit moved from say 11% in FY17 to more than 30% now. Okay. The key AAA rated NBFCs almost retained their share in 43% in FY18 to 44% in FY23. Okay, and the reason is, don't look at 24 because HDFC has moved out. So let's just look at 23. So they maintained their share from FY18 of 43% to 44%. PSU owned NBFCs increased their share, and the ones who suffered were those who didn't have a big daddy. Okay, they were not able to get adequate share of credit. The other big change in is the change in regulatory landscape. Okay, and how NBFC regulations have evolved over time. I will go back to 1998, which was the event I mentioned, the scam of CRB. If any of you is interested, just type CRB scam, and you will get some interesting material to read about it. So that's when prudential norms. So prudential norms were in place, but after that scam happened is when when RBI came up with a very detailed regulatory framework for NBFCs. Then in 2006, they started to classify NBFCs based on their size. Okay, and then in 2015 is when there was a massive change in regulation, which deeply impacted many of these NBFCs. So there was a fundamental difference. As I said, bank also lends money, NBFC also lends money, but NBFCs had to classify a loan into GNP, had to make a provision for a non-paying customer only after 5 EMIs, okay, which is 5 months. Whereas a bank had to make a provision after 3 EMIs. It was fair also, because a bank lends to customers like you and me, but an NBFC lends to a customer who is you can say hand to mouth. Okay. But in 2015, RBI said that no, I want to take away this regulatory arbitrage, is what they called it as. That business of lending is business of lending. It doesn't matter what clothes you wear, whether you are a bank or whether you are an NBFC. I want you to be having the same norms. And it gave it some transition time. Okay, so that was in 2015. And then they said over the next few years, you have to transition to 3 months. Okay. And also came a very big regulation of giving new bank licenses. So in the last time when regulator gave new bank licenses was in 1994, when Kotak and HDFC Bank and a few other banks got license. Okay. And then in 2002, when a couple of banks were given licenses. And then it was only in 2015-16 where RBI allowed microfinance companies. Okay, and very interesting for you to understand this, why, and I will get into that detail. So there were 10 microfinance NBFC MFI, as they were called, were given. This new concept was invented by RBI called small finance bank. Okay, they were called small finance banks, and they said that okay, these NBFCs. So it was the first time, I would say, RBI really recognized that NBFCs truly play a very big role in financial inclusion. And in 2010, the genesis was that in 2010, where microfinance as a product, okay, the Andhra government in 2010, they came up with, so one fine day, they said that no customer in Andhra need to repay a microfinance loan EMI. Okay, and that was a big event that happened, and the microfinance industry lost a lot of money. And a few companies went near bankrupt. The banking industry lost a few thousand crores. And that's when RBI woke up and said that we cannot have a state making such an announcement. So they said that, okay, all these NBFCs, they have to be regulated only by us, and no other regulatory body can really, govern this. So they said, let's make these NBFCs as banks. Okay. And they invited applications, some 35, 40 NBFCs applied, and a few of them got these licenses. And two NBFCs were given a normal universal bank, just like an Axis Bank or a Kotak Bank. Okay. Then another big change was in 2019 and 2020, when these NBFCs were forced to adopt Ind AS. Okay. Which had a lot of implication on their provisions. Okay. And the way they recognize a few items of their income and expenses. This also led to a lot of change. Then again, they brought scale-based regulation framework for NBFCs, wherein they introduced the top layer, upper layer, mid layer, and base layer by size. And they said that these NBFCs are becoming very big. They can cause a systemic risk because they borrow from capital market, they borrow from banks. I need to govern them a lot more the way I govern banks. So they started with saying that all the big boys, so there is no top layer. Top layer is empty right now, but there are 15 NBFCs like Bajaj, Chola, Mahindra, Shriram, Aditya Birla, who were called upper layer. Okay. And then the middle layer was any NBFC more than 1,000 crore of AUM, and all others were in the base layer. So that's what happened. And then in 22 October, again, a big blow to NBFCs, where they said, okay, they introduced this concept of ONAN, ONAN, that once an NPA, always an NPA. Okay. So what it did was, if I am an NBFC customer and I have 3 EMIs due, okay, which I have not paid. Now I have paid 1 EMI, okay, which means I still have 2 EMIs which are unpaid, but then it is less than 3, right? So I am now a customer with less than 90 days of due. So I should not be an NPA. Okay. But RBI said, no, once you have become an NPA, until you have repaid all 3 EMIs, you cannot, you have to continue to be an NPA. Okay. So once an NPA, always an NPA. And this also caused a big dent to the NBFC balance sheets. And then they also extended the prompt corrective action. I think we can skip that. Okay. So these are some of the very important regulations that that evolved over time, with the basic philosophy of the regulator that NBFCs are becoming very big. They borrow from banks, they borrow from capital market. Any NBFC going belly up like DHFL, ILFS can shake up the entire financial system. So I want to control them. They need to be better. They need to be better governed. Okay. Shailesh, I hope we have time, right? Because I think I'm going far slower than what I had imagined.
No, sir, we do have time, sir. Absolutely.
Okay. Do we have any dropouts, or we still have 80 plus people?
Still going strong, sir. I think we can continue, sir. Yes.
Okay. So this, I won't get into much detail on this slide, but essentially is exactly what I said, that the regulatory arbitrage between banks and NBFCs has been nearly eliminated, especially for the upper layer NBFCs, where you can see the green ticks. Now, most of the upper layer NBFCs have to follow many of the rules and regulations that a normal bank has to follow. Okay. This is a great case study. I think Shailesh, you asked this question, that how should you as an investor look at an NBFC?
Yes,
right?
sir. Yes.
So this is a great example of a company called Chola. In 2010, it had gone nearly bankrupt. Okay. Because it had a whole bunch of personal loans, which after 2008 great financial crisis, they had become bad. They were not able to recover many of these loans in time. And you can see its return on assets had fallen down to 0.2%. Okay. You can see my cursor moving, right? Okay.
Yes, sir. Yes, sir.
Yeah.
We can.
Okay. And a return on equity was 2.3. A GNPA became 5.5%, and it was in a terrible shape. So this company, the history is that it is part of the Murugupa group. It had parentage. Its core business was commercial vehicles, but after 2003-4, it got into unsecured personal loans. 2008 got hit very bad, and they said, okay, from here on, I will focus only on what is my core strength. Okay. My core strength is only two products, which is commercial vehicle loans and loan against property, which is basically secured loans. I will not do commercial loans and I will not do personal loans anymore. I will just focus on doing what I do and focus on profitability. So look at FY14. In 4 years, they became 4 times their size because they had parentage. They had Murugupa Group, all banks. They gave them the support. They gave them the loans. I, as a banker, raised money for them in 2010, 11, 12, and 14. The equity markets, the equity markets supported them. They grew their loan book. They just focused on what they were doing, focused on profitability. They maintained their NIMs. So this is the number one thing that they did, that they slightly improved their NIMs because they still had to make up for the losses. So for 15.1, they changed their product mix a little bit within the ambit of secured vehicle loans and loan against property, increased the NIM to 16.8. The cost of funds went up, but at least they got the money. Okay, they got the money, the cost of funds, they went up, but they maintained their NIMs. So look for this trend. Is a company maintaining or improving its NIMs? From 6.9, they went to 7.7. The expense ratios was a little more because they were opening branches. They went from 177 branches to 574 branches, right? But they improved their ROTA, the return on assets, to 2%. They had leverage, yeah, because they had strong parentage. They could borrow 9 times their net worth, and therefore they delivered a 17% ROE. And look at what they did to their valuation. From 0.8 times price to book, they went to 1.8 times price to book. Okay. And this was still a period where the NPA recognition was at 5 months. Okay. And then came in FY15-16 the regulation where you had to move to 3 months. And then I have a column for 17 where they grew their loan book, they grew their branches. Here, now they started to now focus on even better quality customers. Okay, because they were now profitable. They had reached a certain scale. They started reducing the risk on their balance sheet. Okay, and they continue to keep a high leverage. So there are two risks. One is a business risk, and the second is a balance sheet risk. Because these was part of a big group, they said we can take balance sheet risk because banks are willing to lend to me. But then I don't want to also take a very big business risk. I already have one bad experience. I am now profitable. I have now re-established myself. I will reduce my risk. So they started to look at better credit customers. Okay. So their total incomes came down from 16.8 to 14.3, but then their cost of funds also came down. So actually the NIM was maintained. Okay, from 7.7, despite the change in their mix. This is the learning. This is what you observe when you're looking at any NBFC, that how are they managing their business risk. Okay, they also brought their costs down. They worked with McKinsey. They worked with the razor sharp focus to bring their costs down. Their credit costs came down from 1.5 to 1%, and their ROTA, which is a return on total assets, moved to 2.2, and the return on equity improved to 18.1% from 17.7. And this is when they started, when the 3 months thing happened. So GNPA went up to 4.7. Okay. but actual credit cost did not move up. It was now only that you were providing more because of change in regulation, but it was not that the customers were defaulting. Okay, so going back to the earlier conversation about credit worthiness, right? Just because you are forced to recognize a customer as a GNPA doesn't mean his credit cost behavior is changing. Okay, it is just that you have to make an early provision on your balance sheet, and look at what that did to their valuation. 1.8 times price to book, they moved to 3.5. Okay, and let's continue the story. Of course, FY20 is a period of COVID where 20 and 22 they had a big impact on their balance sheet because of COVID. But still, see what happened. They continued to improve the profile of their customers. By 22, their yields, it further came down to 13.7. Cost of funds improved even more, because as we saw in this period from 18 to 23, the AAA companies or companies with parentage got all the money, right? So this company got all the money it wanted. It was able to improve its NIMs from 6.9 to 7.9. So it brought its costs down. Its loan losses went up because of COVID, but its ROA went up to 2.9. Then it started even reducing its leverage a little bit, and they still did a 20.4% ROE. Okay, and look at what that did to their valuation. From 3.5 times book, it became 5 times price to book. So clearly, ROE is a driver of valuation. So Shailesh, you were asking how, as an investor, whether as a buy-side analyst or a sell-side analyst, how do you analyze an NBFC? Look at a company over a long period, how it has behaved, how it has tracked its P&L. Okay, what has been the strategy for income, in terms of the yield, the cost of borrowings. It's a very simple business, right? You have only 4 line items in your P&L: yield, cost of borrowing, the OPEX, and cost of credit, right? So what is the right mix? Where are you taking risk and where are you balancing it? Okay, and then FY24 is now again where they are diversifying their customer base, because now they crossed 1 lakh crore of size. Now finding it hard to grow with just 2 or 3 products. Now they are becoming diversified. Now they are saying, okay, at 1 lakh crore is very hard to grow, but so now they're adding newer and newer products. So their yields are going up. Their cost of fund has also gone up. Okay, and their expenses have also gone up, but they are maintaining their credit cost, they're maintaining their leverage, and they're still delivering 20% ROE, and their valuation is also at 5 times book. Okay, over this period, so look at how they have changed their product portfolio in FY14. As I said, after FY10, for 4 to 5 years, they just focused on 2 products, which was vehicle finance and home loans, loan against property. Okay, it's called so while it is HL, it's actually loan against property. Okay, and now they have entered into MSME finance, they have entered into SME finance, they have entered into proper home loans, and 1% of their balance sheet is personal loans. So this is what is giving them the growth in balance sheet, as well as a little bit of kicker in profitability, because personal loans, they tend to be high yield. Okay, so that's how they have changed. So they have been now agile in their product, which is helping them maintain their margins while building scale. Okay, a fantastic example of this is also Bajaj Finance, which I will just cover. But let me come back, since this section is about how to respond to regulation. So I talked to you about regulation. So Mahindra Finance is a great example, where in FY15, as I said, RBI asked NBFCs to start aligning to banks, and to move the GNPA from 5 months to 3 months. Look at the jump in the in the GNPA from nearly 5.9%, it moved to 8%, but credit cost did not change. It's just that the balance sheet got impacted, the profitability got impacted. So the ROE came down from 15% to 6% because you had to make more provisions. Okay. And then they would recover this. These provisions would eventually roll back. Okay. But then COVID happened and the valuation really dipped. Okay, in the period of COVID. And then now that COVID is out and improving asset quality leads to a direct impact on valuation. So I think to Shailesh, to answer your question, there's a direct correlation between how, what is your credit quality and your valuation. Okay. So from monolines to multi-product to achieve scale. So as I had shown you, 37 companies, and I can maybe go back to that slide. Okay. Where you have half a dozen companies now who are very diversified. And these are the Cholas and the Mahindras and the Srirams and the Bajaj. Okay. Whereas you have the Awas Financiers, SBFC, you have Manappuram, who are Manappuram, Muthoot in the gold. Okay. So there are still at a smaller scale, you can remain as product specialists, but beyond a certain size and scale, most of the companies are becoming diversified, whether that number is 75,000 crore or 1 lakh crore. It's just a number, but typically after reaching that number is when many of these companies are starting to diversify their product portfolio. Okay. So this is a great example of the top 4 companies. What they did was when Shriram reached a size of around maybe more than 1.5 lakh crore, is when they merged a group company called Shriram. So it used to be called they had a Shriram Transport Finance, which was doing only vehicle finance. And the same group had a company called Shriram City Union Finance, which was doing personal loans, car loans, two-wheeler loans, gold loans. They merged these 2 companies and they made one single company because as a standalone, it was they both were finding it difficult to grow. Okay. So for Shriram Finance, for Shriram Transport Finance, which became the acquiring entity, and Shriram City merged into it, they suddenly added like 16 lakh crore of market segment, right, to Shriram Transport Finance, and the yield moved up by 500 basis points. Okay. For Mahindra Finance, which was predominantly only into tractors, tractor financing or car financing or commercial vehicle financing, they have now added SME, they've added micro lab, they've added personal loans, so added nearly 28 lakh crore of a total addressable market. But for them also, Mahindra Finance, they want to go to better quality customer, because tractor is a very rural, agri dependent customer, very cyclical, very seasonal. So they wanted to improve the risk on their balance sheet. So their strategy was to go into newer markets to reduce the risk on balance sheet. Okay. The same was for L&T Finance, wherein they went through a lot of losses. Half their loans were to infrastructure, wholesale, and they went through a bad period after IL&FS. So they expanded market share and they kind of maintained their NIMs. The same was for Bajaj Finance. They were doing consumer durable loans. They were doing a lot of personal loans, unsecured loans. So they wanted to de-risk their balance sheet a little bit, as they became more than 3 lakh crore of balance sheet. So after HDFC, that's the largest AUM in an NBFC. So for them, they added 38 lakh crore of total addressable market, as you call TAM, but also their yields would be lower by 70 basis points as they go ahead. So different companies have different strategies. So based on the risk on the balance sheet, okay, that they want to take. So Bajaj Finance, interestingly, this was another company in 2008, like Chola, which had a huge problem. because at that point in time they were largely doing um, two they were largely doing two-wheeler loans, scooter loans, motorcycle loans to its parent or sister company, Bajaj Auto. It was like a captive financier. They were doing a lot of personal loans, and 2008, these two products were massively impacted. And but because they were part of a big group, they were able to come back. I think if I remember it right, the company parent group invested 600 crores in the company in 2009 to revive this company. Okay. And then they said, okay, we need to have a multi-product portfolio. So they started behaving like a bank right after 2008. And if you look at this chart on the top right, until 2008, they had only 4 products. But between 9 and 17, they added 31 products. And then every year they kept on adding products. 18, 19, 20 was a tough period. It was a period of consolidation, even for them. And then COVID, etc. And now they are at 44 products. I think it is probably more than the number of products that even probably any bank will be offering. Okay. So they and then now when now meaning in FY23 ke baad mein, they started adding even more products. Okay. So they started adding tractor financing. They said we will not be only a Bajaj Auto two-wheeler financier, but we will also finance two-wheelers of other manufacturers. Gold loans, they will get into microfinance loans, they will get into emerging corporate, etc. So they have added 38 lakh crore of TAM to them. Okay. And a very interesting strategy, the chart on the bottom right, wherein some of these loans like tractor, gold or MFI, which will be high yield loans, will give you a lot of profit. Okay. And some of these loans like affordable home loans or secured MSME, emerging corporates, they will be low yield, but they will give you scale, because these tractor gold are very like 2-3 year products. So it's like on a treadmill. You have to keep, so every year, 1/3 of your balance sheet will run down. If you're giving a 3-year loan, a gold loan, is a 12-month loan, or at best a 2-year loan. So every year, half your balance sheet or your full balance sheet will go away. So these will be scale builders, these will be profit builders. So very, very well, balancing scale and profitability. So that's how you analyze balance sheet or a NBFC business, Shailesh, that what is the strategy? Okay, and how do I see this company going ahead in the next 5 years? Okay. Shriram Finance. So when this merger happened for Shriram Transport Finance, which is the line that you can see where my cursor is, the lighter blue, their yield was 16%. The products, the Shriram City Union Finance was selling, their average yield was 21%. So they had a yield enhancing strategy. Okay. That's what they followed to create a large diversified portfolio at scale. I'll just pause here, Shailesh, if there are questions, and it'll be great if the students ask me the questions directly, Shailesh, instead of you asking on their behalf. It'll be nice to hear some very young voices. So
Of course, sir. The only reason I'm actually trying to relay the questions is because quite a lot of them are overlapped. Don't really want
okay.
any.
But I think let's give opportunity at least for for a few people to ask questions.
Of course, sir. Maybe Rahil, you want to ask the question you have submitted?
Sir, my question is that recently in the newspaper there was an interview regarding L&T Finance, that even after being in the business for 3 decades, they are still catching up in this field with M&M Finance and Bajaj Finance, even though M&M Finance and Bajaj Finance came in much later than L&T Finance. So I just wanted to know what are the things that they are doing wrong, that for 3 decades also they have not been able to make up the market despite
Okay.
being a very big conglomerate.
Okay, so it's a very, very good question. But Rahil, would like to refrain from commenting on any one specific company, okay? Because I'm also working in a large AMC. We have 90,000 crore of AUM. We may have invested in that company, etc. So, but I can tell you uh, as a generically, okay, or the way I have explained actually so far, I will ask you to ask the right questions by looking at their balance sheet, okay? So are they in a product segment where they have some leadership, okay? Like today, Bajaj Finance is known for consumer durables. You go to any consumer electronics store, um, you will see Bajaj Finance, okay? Uh, it was the number one consumer durable player until maybe a few years back when HDFC Bank also entered, then IDFC Bank entered, but it is there in maximum number of outlets. Okay, if you look at Shriram Transport, it is known for used commercial vehicle finance. They have a disproportionate market share, so they have leadership. They drive that business. Okay, they drive the terms of trade in that business. Look at Chola. When it comes to commercial vehicle, they focus on small commercial vehicles, the Eicher and the Tata Ace type of vehicles. So they drove that the market leadership there. Okay, whereas some other companies, because they had parentage, okay, they had the advantage of access to borrowings, they had the advantage of low cost borrowings. They wanted to grow very fast. I think they diversified a bit too early, okay, and started doing too many things where it became very difficult for them to, for many of these companies to say that I am market leader here and I can make an impact. Okay, and I think many of these companies were lending to difficult sectors like infrastructure. We went through a bad time. Through microfinance, we went through a bad time. Okay, and from an investor point of view, right? If I want to invest in a diversified portfolio, I will go to a bank. Okay, many of these companies started to also compete with banks, okay, or just lesser than a bank customer, which was not giving them enough yield. So, like I said, Avas is lending at 13.5%, and a Bajaj Housing Finance is lending at about 8%, 8.5%, but a bank is giving a home loan at maybe 100 basis points, which is lower than that. So there wasn't enough a delta in their yields to compensate for that borrowing, to compensate for the credit costs. Okay, so I think ask these questions when you look at the balance sheet or annual report or investor presentation of any NBFC.
Thank you so much, sir.
Thank you so much, Umesh, sir. We'll take one more question and then perhaps we'll move further with the presentation, sir. There is one question. Just a second. From Jainam. There are a few stock specific questions which I'm trying to avoid.
Yeah.
Don't really want to put you in any particular
Yes.
spot or ethical or unethical issues. Jainam, maybe you're there? Jainam?
Yes, sir. Yes, sir. So sorry. So thank you for taking the question. So my question is like, a NBFC is on mercy of a bank. Basically, they are getting loans from the bank and paying it outside. So why would someone invest in an NBFC over a bank? Let's say, because if there is an NBFC, they would be lending at a higher rate. So there would always be a quality of customer difference between a bank and an NBFC. So why would I increase my risk with exposing with getting an exposure to an NBFC over a bank?
Yeah. So I think as we saw in some of the slides, as long as the higher yield is compensating for the likely credit loss, okay, just because a customer is poorer and therefore willing to pay a higher interest rate does not make him bad credit, right? It is risk adjusted yield is if you see that, or risk adjusted the thing is, if you see, if that is favorable, then actually that NBFC can grow, because the market is very big, right? There is, in the same area in Bombay, if you're living in, in any area, in any city, whether it's Bombay, Bangalore, Delhi, in the same area, there will be a person who earns 25,000 rupees a month, and a person who earns 5 lakh rupees a month, and a person who earns even higher, right? All these people need credit, and the same entity, bank, cannot reach all these customers. It cannot have a business model. So you need different cost structures, you need different organizational culture to deal with a customer earning 25,000 rupees a month versus a customer earning 10 lakh rupees a month. So you need to have different entities to be able to do that.
Understood. Sir, just one more question if I could ask.
Yeah, sure, go ahead.
So, like we discussed like right now that uh, a Bajaj being a diversified player and a small NBFC would be more concentrated player, which would be much more riskier than buying a Bajaj, because they would be much more concentrated, much more dependent on a single sector. So, one question is, uh, the exposure on a small NBFC would be much larger than exposure on the Bajaj. For example, a Bajaj. So why would I choose a Bajaj over? Why would I choose a small NBFC over a Bajaj?
Yeah.
And second question on that was uh, so that's the main question. The both question.
Okay, you got it. You got it. No, it's a fantastic question, and I don't think there is any right or wrong answer to this. But the way I would see it is that every company. So when you're evaluating a company, okay, where say a smaller company, 5-10,000 crore of loan book company, first question, or even a 1 lakh crore company or a 3 lakh crore company like Bajaj, okay, ask this question. I think I also said this when Rahil asked me the question, right? What is the moat of the company? Why? What is his business model? Can he say that I do this best, okay, or I know this very well? I I um, so like for an Avas, okay, he is like 50% of a business is in Rajasthan, okay. It has a pro, it has a con. The pro is that he owns that market. He has the best understanding of that state, okay. Therefore he can potentially say that I understand credit here best. I have a market share presence, people know me. There will be customer who will refer कि यार मैंने आवास से लिया था, I had a great experience, so you also take from Awas, okay. The con is, if something happens in Rajasthan, like a flood or a earthquake or a thing, he will be most impacted, right? It has its pro and con. But diversification for the sake of diversification is not good. That um, after reaching a certain scale, and which is what, say, a company like Chola did, after crossing 1 lakh crore or thereabouts, is when they started going into other product. When they said, okay, my core product, I have grown enough and I cannot grow more, or when I need to diversify my risk, okay. So what is the reason? Like, diversification, is it really reducing risk, or unnecessarily you are taking more risk? At a 4-5 thousand crore AUM, if you are if you are doing five different products, it's a problem, because you will not have enough expertise in any one product, in any one customer segment, or in any one geography. There's a saying, jack of all trades, right, and master of none. So I think that's the question you have to ask, that is it diversification for the sake of diversification? Where is your expertise? Are you able to say that I have done this product very well, now I can go to another product, or I'm a king in this region, now I'm going to other regions?
Understood. That answers my question. Thank you.
Okay, let's go ahead. So ROA tree, maybe I can, yeah, let's look at this. So these are two housing finance companies. Okay, so a Bajaj, which lends to a different class of customer, their average yield is 9.8. Avas is 11.8, so 2 percentage points higher, meaning a very different customer segment. Cost of funds would be different. So this is ROA tree where where the denominator is asset side. Okay, so why this appears lower is because it has a very high equity base. Okay, the leverage is only 4.2 times for Avas versus 6.4 times for Bajaj. That's why you have the cost of funds becomes lower, because the denominator is the asset. So the NIM of Avas would be higher. The other income is what you charge as processing fees. So typically all these NBFCs, what they do is, there is a, to say if they have to evaluate 4 customers to give loan to 2. Now that, uh, so all the 4 pay some processing fee, typically a few thousand rupees. And that's what covers the cost of origination, cost of verifying the documents, etc. So the total income, the OPEX is the cost of branches and the people. So this, look at this, the OPEX of a company like Bajaj Housing is 1% as against 3.7 for Awas, because it's very granular. A lot of customers of Bajaj Housing Finance will be higher class customers who will have, say, Form 16, who will have, who will have GST returns, etc., which are amenable to using a lot of technology. Okay, there will be bigger ticket size loans, so it gets spread over a larger uh, over a larger loan value and lesser volume, whereas the loan size of Awas will be 10 lakhs. So it gets spread over. So there's a much more higher volume, and hence you have this OPEX. So you need to have high yield to compensate for this higher OPEX. Okay. So the PPOP, the profit prior to provisions, and credit cost is not very different, right? And this goes to say that a poor credit, uh, a, a credit poor is not necessarily poor credit. Okay, so PBT is higher for a company like Avas than compared to Bajaj Housing Finance, but because Bajaj has parentage, it has much higher leverage of 6.4 as compared to 4.2 for Avas. It ends up earning higher return on equity. Okay, it's again that thing about parentage, that if you have a strong parent, you can get more borrowing, so therefore you can improve your ROE. I think we can skip this. So this is just reminds me of, I think the picture on the left you can see is of this Surya Kumar Yadav in that famous catch in the World Cup, which helped us to win. Got a lot of attention, a lot of us talk about it. But how many of us remember that 2 years back in the women's cricket team, this cricketer called Harleen Deol also had done this catch, but she never got as much attention as a men cricket team got, right? So that's the difference between a bank and an NBFC, or NBFCs with parentage, NBFC without parentage. From a from a lender perspective, or from a capital market perspective. So I think just on the lighter side. Okay, valuation. Uh, so interestingly, financial services in overall market cap of NSE, okay, pre-COVID, it was at 27.8 or 28% of entire market cap was this sector. But after COVID, this has really changed. It dipped to nearly 20%. So this has been actually the most underperforming sector after COVID, where the Sensex has moved to like 85,000. It is busting all charts, but this sector has been an underperformer. Within that, if you break it up into the left side, which is all lending businesses, which is banks and NBFCs, and on the right side, non-lending businesses, which is basically insurance companies, asset management companies, and stock exchanges, depositories, etc. They have maintained their share, but it is the lending businesses which have come down from 23.5% to nearly 16%. Okay. So this sector has not recovered multiple reasons. So one was COVID and the losses after that. The others was that FIIs own this sector disproportionately. So when FS share in overall market cap was 28%, the share of FS in FII portfolio was 38%. So they were overweight on this sector. And when they exited this, when they were selling in India, okay, or in emerging markets, when interest rates went up in the US, this was the sector from where they exited because they had a lot of exposure. Plus, this is the sector where the free float is very high. Okay, there are no promoters. Like ICICI Bank has no promoter, so the entire capital is free float. Whereas in RIL, the Ambani family still owns a very large percentage. Like Adani, the Adani family owns a very large percentage. Or in Tata Motors or TCA, there is a Tata Group which owns a large stake. But most of the banks and NBFCs are not owned by any promoters. So free float is very high. So they're very liquid counters. So when you want to sell, when an FI wants to sell $100 million position, this is the first sector where they will sell. But it also is on the reverse side, right? When FIs will start buying in large quantities in India, now that interest rates in US are coming down, this is the sector where they will first buy, because it's easier to buy a $100 million block in a company with a bigger, with a free float without impacting the price. So we think that this sector should come back as and when these market dynamics change. So in the last 1 year, we are seeing we are seeing that trend where valuations across various segments, and I have categorized this as say large banks, where 1 year back the price to book was 1.7, now it is 1.9. In PSU banks, all of you know they have gone through the roof. Or housing finance companies also, or whether it's asset finance companies, all valuations have moved up in the last 1 year for this sector. But yet, from a pre-COVID perspective, most of the companies, with the exception of Chola, every company, even Bajaj Finance, its price to book is lesser by 7% than its 5-year average. Okay, so there is still a lot of catch up that these companies have to do on valuation. Okay, typically the metric to use is price to book, which is which has a direct correlation to ROE, and therefore you see this trend line, and everybody's kind of reverting to this trend line in some shape and form. So this is the key metric, price to book versus ROE. The next chart is price to earnings versus ROE. Here there is no trend line. So what it says there is that P ratio is not so relevant when it comes to evaluating NBFCs. It's price to book relevant or relative to the return on equity. Okay, so I think under penetration of retail credit will pave the way for many Davids to become Goliaths. I think that is the basic, the message that I want to convey, that even after so much growth, 20 lakh crore of market cap, 21% share of credit, but still India, only 22% of adult population has access to credit. Okay, and the percentage of the penetration of personal loans in India is very low. It's like 5-6%, which is lower than most other countries. Like mortgage to GDP ratio in India is only about close to 11%, whereas every other country, like in the US, UK, it would be more than 60%. Even some of the other countries like Thailand is at 20%, or China is 22%. So there's a long way to go for lending as a sector, where I think if our economy has to go from 4 trillion to 8 trillion, it cannot be without growth of financials. Financials cannot grow without NBFCs. Okay. So what this means for us as a job aspirant, you can look for careers in NBFCs. You should negotiate you should negotiate a part of your salary as ESOPs because NBFCs get very well valued. They make a lot of money for shareholders. If you're a sell side analyst, you can actually, because it is such a large sector, you can build a whole career by being a financial sector analyst. Okay, for a large part of my career, I was doing deals only in financial services. So it is such a is a very big sector, whether you want to work as a sell side analyst or a buy side analyst or as a banker or even an entrepreneur. Many of the NBFCs that are coming to the market today are actually founded by entrepreneurs who have worked for 15, 20 years in large banks or large NBFCs with backing of financial investors, private equity funds. I think in the last 3 months, you would have seen, including in this week, like EQT Bearings acquired Indostar Home Finance. 1 month back, this fund called CBC Capital Partners acquired Avas. Warburg Pincus acquired Shriram Housing Finance. So there is a lot of money chasing the NBFC sector. You can even join an entrepreneur or become an entrepreneur yourself. So I'll just pause here now because that's the last slide of my presentation, and Shailesh, we can do another round of a few questions.
Definitely, sir. I think I'd like to start with the question first.
Sure.
So we talked about how to go about taking a look at NBFCs, and that was an amazing answer, obviously. But in your slide, there was a section where you talked about the quality as well. So where you talked about the breakup of the GNPA as a percentage and likewise. So my question comes from evergreening of loans. Like, how do you identify from a fundamental perspective whether a practice like this is being actually, is there a way or any other way for us to identify, not may not be from numbers, but any other practice which you would recommend an analyst who is working with you to check whether something like this, or in a manner how you go about taking a look at these practices?
Yeah. So it's a very, very good question. I think we are seeing this problem. Evergreening earlier would always happen in wholesale loans where large groups, they had companies which were in difficulty. They would go to the bank. Okay, you lend to this company, which is a group company, and I will move the money here and I will pay you back, and the cycle starts. So evergreening, is a problem. In MFI, it was very prevalent where earlier to repay one MFI loan, so another MFI would give you the loan and you would take that. So a person would always remain, in debt. So in 2015, as you notice, I said that RBI mandated everybody to share the credit data with everybody, right? Now also, when this MFI crisis again happened after COVID, okay, so RBI came up with rules that no more than 2 or 3 loans to one customer, and that data is there in the credit bureaus. So a lot of these NBFCs, they have access to that. Now it's not just 2 or 3 MFI loans. Now, as I said, this whole multi-dimensional underwriting. What other loans do you have across products, right? So that FOIR. So those are the ways in which you can find out the level of indebtedness, the possibility of evergreening. It's hard to eliminate it completely, but by discussing with the management, by doing some field checks, okay, by actually going into branches, by actually meeting some customers and getting that sense is what you as an analyst should figure out on and develop a sense of the possibility of evergreening.
Thank you so much, sir. So next question is from Rahul. Rahul, you want to ask the question? Rahul, you there? So I have his question on chat. Let me relay that question.
Yeah.
So Okay, so how it helps to prioritize sectors like affordable housing and MSME, because tier one bank cannot meet all the requirements of MSME. So how much is the contribution of NBFC in company lending?
Sorry, I didn't understand the question.
So I think he wants to ask a question on co-lending model.
Okay.
He wants to ask whether, just a second, I'm just trying to, this cannot meet the requirement. Okay, so because just one bank may not always be able to meet the entire requirement. So typically the co-lending models, how it helps to prioritize sectors like affordable housing and MSME. I'm not really sure. Even I
Yeah, no, I
think
think
that,
let's move to another question.
yeah, I think there are 2, 3 questions in there which I'm not able to relay properly as well. I think Rahil had a follow-up question which he wanted to ask. Rahil, you want to start with that?
Yes, sir. Thank you for once again giving me the opportunity. My question was, sir, that recently the central government and the RBI together, they have said, RBI have said that they are going to start a ULI interface, just like the UPI. Uh, and the central government is going to start a blockchain for public data for transparency and trust. So, how these two moves together are going to benefit the NBFCs, because NBFCs are also in somewhat unsecured loan category. They also tend to give a lot of personal loans. So the ease of giving a loan is going to get very simple through ULI scheme interface. So what growth should we see in the NBFC sector because of these two things? Because data collection would be easy and the loan giving capability would also increase, right?
Yeah, no, it's a very good question. So I think it could become a game changer because of access to more information, access to more customers with information. Okay, it'll help in improving the quality of credit. ULI along with UPI, the whole process of disbursing the loans and collecting the EMIs. Okay, like many of the earlier loan segments, like for example a truck driver, I keep giving that example again and again. He is moving his truck all over the country, right? Earlier he had to wait to come back to his hometown or find a branch of Shriram Transport on his way where he would go and deposit his money, right? Now he's getting payment from his customers like through UPI, through into GPay, and now he can pay his loan in installments or in smaller pieces to his lender as and when he gets the money. So how UPI has eased out these payment problems, ULI and payment aggregator or account aggregator will make that flow of information much easier, and therefore the NBFCs will find it a lot more will find it a lot more easier to lend bigger ticket sizes to customers and to a deeper type of customers, which earlier would have been harder to reach. So it could become a game changer.
Thank you so much, sir.
So the next question is from Deep. Deep, you want to ask?
Yes, sir. Thank you for the opportunity. Sir, my question is a new fintech startup who giving personal loan in small ticket size and charging 20% or more interest rate, uh, and they are backed by NBFC or bank. And second question is, in this lending, due to more failure rate, and that is a sustainable model or not? What's your outlook?
So fintechs usually have either their own balance sheets. Okay. Earlier, fintechs started with the concept saying that we will not have our own balance sheet. We will just be a platform. We will source the loans, and I'll find some bank or NBFC at the back, and I will just be a platform connecting them. But after COVID, after all this, they figured out that it's very hard to depend on somebody else. You need to have your own balance sheet. So many of them started to have their own balance sheet, but then if you didn't have a parent, you did not get borrowing, so you could not scale it. So then this concept of co-lending came, where RBI said that a bank and an NBFC can work together. Most fintechs took an NBFC license, and they said, okay, we will do a co-lending, wherein out of a 100 rupee loan, 20 rupee will be on the bank, will be on the balance sheet of the fintech stroke NBFC, and 80 rupees will be on the bank. Okay. So this kind of models evolved where you as a customer, Deep, you will not face any so for you, the whole process will be very seamless. Okay. At the click of button on that fintech platform, you will get the loan and you will be signing digitally, etc. And some part of your loan will be from that NBFC, some part of it will be. So for you, it will be seamless, but at the back, there will be a split of 80-20. Okay. Now, as far as credit cost is concerned, it's all a function of how they have evaluated your credit worthiness and what kind of collection infrastructure they have to make sure that you're honoring all your EMIs in time, and if there is a delay, then how fast they can reach you, and uh, and how fast they can collect the EMIs. Okay, so so the other issue with fintech personal loans, which again, as you would have realized a year back, RBI came down very heavily, and and they said that a lot of these personal loans are actually being used to invest in the stock market in the FNO, right? So last year, they started discouraging through regulatory intervention the growth of this business. So the business which was growing at some 35-40%, the growth has now come down to maybe in the 20-25%, because they wanted to control this, right? So wherever there is no tracking of end use, like if you give a loan to a poor guy who's taking a loan to buy a truck, he's using it for his livelihood, right? So I have given this loan, and you probably gave that, you disburse the loan to the vehicle, to the dealer, so there was no leakage. But in personal loan, this is a big problem. You cannot track the end use. You may say, I want this loan, and go on holiday, right? But there are some fintechs which also say like specific purpose. So you want to do a course with Finacle, it's going to cost you say 50,000 rupees, and Finacle has a tie-up with IDFC Bank, and IDFC will say, I will give the loan directly to Finacle. So there, or I want a medical loan where I'm getting treated. I'm going to this hospital. I have this treatment. They will give directly to the hospital. So those are some of the ways in which they are trying to reduce the probability of default, right? But there are still loans. I mean, there are people who are going on holidays with loans. It's a very different customer segment. There, the interest rates will have to be really high enough. The person will have to have a stable job, and all those things, the FOIR, that the repayment capability will have to be seen.
Thank you. Thank you.
Thank you so much, Umesh sir, for a detailed answer. I know we are already 20 minutes over and above the calendar time. So, just last, two questions, and I
Yeah.
hope we get to ask those. So the first question is on the reading material, because, obviously it's a constant learning process for all of us. Any unheard material which you would like to recommend to these young budding investors or aspirants so that they can actually create a great career out of themselves?
Unheard material meaning I don't understand.
Any material which comes to your head which may not be so popular, but you found it to be extremely useful and helpful at some stage of your career.
Uh, I don't know. I think even there's so much material that is out there which not everybody reads. Okay, so even if you read just what's available, it's like you don't have to do different things. You can do the same mundane thing, and that consistency with which you read, I think that can just make the difference also. So I'm sorry, I don't have any unheard material like this. Yeah.
Thank you, sir. So the last question which we wanted to ask, a key piece of advice which you'd like to give these young, again, candidates, which they can definitely try and learn from you and implement it, a mistake or any piece of advice which will help them.
with respect to like NBFCs and
Anything, sir, anything.
okay,
As
maybe I
far
think I
as,
can just say
yeah,
that whether you are looking at so when you're looking at say a capital market career, whether as a sell side analyst, buy side analyst, or investment banker, fund manager, I think reading research reports, reading newspaper articles, editorials. I think 1 hour a day, if you put on your calendar minimum, like even while you're a student or when you're working, say 50 hours, 60 hours a week in any of these investment banks or AMCs, I think if you reserve an hour a day to read random stuff, I think that will bring you a lot of perspective and will eventually help you create a differentiation.
yeah. Thank you so much, Umesh sir, for your time, and we could learn quite a lot. We hope you bless us with similar opportunity in future to learn again from you.
Certainly, certainly. No, I also had a great time interacting with these young minds, and we can do another session maybe sometime in near future. Or you can suggest me some subjects, and I can work on it and come back. And it'll be good to get some feedback from the students. What different uh, like what parts they liked or what parts could be done differently. I think that would also be useful.
Definitely, sir. We'll get back to you in case of any positive or constructive
Or
feedback.
improvements. It's both ways.
Yes,
Yeah.
sir. Definitely,
Okay.
sir. Yes.
Thank you. Thank you,
Thank you so
everybody.
much, sir. Have a good day,
Bye.
sir.
Bye, everybody.